Hi, I'm Mark Steber, Chief Tax Information Officer here at Jackson Hewitt Tax Service. While there are many life changes that can impact a tax return, there's almost nothing quite as big as retirement. Today we'll be covering tax tips to help taxpayers who are either planning for retirement or who are recently retired. To start, the tax issues retirees run into are not just the fact they've stopped working their traditional job. It's much more complex, and more so than just a few years ago, when folks just had a pension and Social Security for retirement. Whereas today's retirees typically have a variety of savings and retirement plans, each with different tax issues. Let's get into my basic tips and advice. My first piece of advice to taxpayers is the need to plan ahead. In most cases, taxpayers should be planning for years before retiring. In fact, as early as when they first start working. Taxpayers planning on retiring should keep detailed records up to and after retirement, more so than their earnings years. These records should include information about contributions, withdrawals, distributions, and money taken out of any account for any reason. Don't take shortcuts or leave something off of your tax return. If you do not understand something, find out. Leaving an item off can be just as bad as putting all on as taxable, when it might not be. No one at the IRS is going to lower your amount because it was wrong. Retiree taxpayers can typically have investments in multiple retirement accounts, ranging from IRAs or individual retirement accounts, 401ks, self-directed savings accounts, company plans, and just plain old savings. A mix is pretty common and a proven best practice. But for taxes, it can be very confusing. So make sure you understand the implications for each account. Some of these accounts may provide tax-free income in retirement. Some allow you to take money out early. Others have requirements. And some savings are just money to be used at any time, with little consequence on withdrawal or taxation. Next, many retirees consider working a side gig to keep earning during retirement, while also drawing on retirement funds. This helps retirees remain active and involved, plus puts a few extra dollars in the pocket. But recognize that having a side gig during retirement has tax implications. You must pay taxes on your earnings, even as you withdraw from Social Security and retirement funds. On that note, make sure you understand how your Social Security benefits work. They are complex and can be partially or heavily taxable based on income levels. And even when these benefits start, you have many distribution options to choose from. Understand that some retirement income is considered tax-free, like a Roth IRA. But if it's reported incorrectly on a tax return as taxable, the IRS won't let you correct that mistake after a period of time. And they're generally not going to check it for you. If you misreport it, it stays misreported, and you may be paid too much tax. Lastly, make sure you understand how your individual state income taxes will impact your retirement, especially those who live in a different state than the one in which they worked and earned their retirement funds. Taxpayers should enjoy their retirement. Work with a trusted Jackson Hewitt Tax Pro to answer all of your tax preparation questions. Schedule an appointment at jacksonhewitt.com today.